Greetings and welcome to the Remote Real Estate Investor. On this episode, I'm joined by
Emil Shore.
And Michael Albom.
And on today's episode, we're going to be talking about portfolio acquisitions as well as portfolio management. Now, obviously with a portfolio, it's a little bit more money to get into the game and to buy multiple properties at once, but there are a ton of advantage. So within this episode, we're going to talk a little bit about reasons why, some tips in different phases in acquisitions and management, and a little bit in between. All right, let's get going. All right. Excellent weekend wisdom today. So we're going to be talking about portfolios. And for the conversation, I think I'm going to be really leading a bunch of it. And Michael and Emil are going to be peppering some stuff in. But I'm going to talk about my experience in going through a portfolio acquisitions. I'm going to start by talking about the benefits. And then we're going to go into the specific process, some different ways to go about it. So Michael and Emil, I'll start, but you guys can feel free to pepper in. So I'll start on the acquisition side. There's some benefit in buying portfolios in that you can deploy more money at once.
What is a portfolio for people who don't know what a portfolio is?
Excellent hosting, Emil. So a portfolio would be considered buying multiple properties at once from the same seller. So Roofstock has some cool features around buying portfolios. Just a quick plug for the marketplace.
And selling.
What we're going to be and selling. That's right, and selling. So, but this episode is going to be agnostic to where you do your buying and selling, as all of our advice is. But we're going to be talking about specific portfolio related stuff. So, any other clarifying questions there for me, Emil?
No, that was it. Continue, Tom. Sorry to interrupt.
Okay, so we're going to start with benefits. So one of them, as I was getting going, is the ability to deploy more money at once. Oftentimes, when I'm in acquisition mode, I have a target amount of dollar that I'm trying to spend, and it's much easier to get to a bigger dollar amount in buying multiple homes, right? Pretty straightforward, but there is for sure some real benefit to that. The other benefit is, this is somewhat intuitive. It's kind of like going to Costco where you can get a little bit of a discount, I'd say, versus just buying individual properties. Oftentimes when I'm submitting my offer on a property, on a portfolio, I'll just sort of put a blanket dollar amount for both of them. And when I'm underwriting them, I'll put in the specific individual numbers. But at generally speaking, in making that portfolio acquisition, you're usually able to get a little bit more of a discount to the marketplace. The benefits on the operation side is typically portfolios are in the same market. So I love being able to scale a little bit quicker in a market. Perhaps this could lead to some discounts from the local property manager because they're managing multiple properties. Perhaps even discounts related to the lender or not lender, maybe the lender, but the insurance as well. But generally speaking, your OpEx could see a benefit or a boon by doing things in a little bit of scale, just because you're able to, get a little bit of economies of scales from the vendors, perhaps if you're able to negotiate that.
And what's OpEx, Tom?
OpEx would be operational expenditure. So perhaps your property management fees, all basically blanket for that. Am I articulating that correctly, Michael?
Yeah, totally.
Any other benefits you guys see on the acquisition operation side that I may not have touched? Oh, I see Emil's raising his hand. Emil.
I think one benefit to buying a portfolio is that you have less competition. I don't think people are as attracted to portfolios because you have to put more money down. You're buying multiple, the seller may choose to only sell the portfolio, right? I have these 3 properties. I will not sell them individually. You have to buy all 3. So that will create less buyers, I think. So if you play that right, you know what you're doing. I think that can be an advantage to you as the buyer.
I'm gonna push on you both a little bit. You both now have mentioned needing more money or the portfolio being more expensive, but is it always?
Not necessarily. I think that the cost per unit should be less because you're in practice you're getting a little bit of a discount. But I mean, if I'm going to buy a super expensive house somewhere, right, I'll be deploying more money doing that, Michael. But
Yes.
Michael.
Yeah, Michael.
You can't just say my name and then assume that it's making your point
With
stronger.
that tone, it kind of works. It kind of works.
You're wrong, Michael. Here's why, Michael.
No, that's exactly the point that I was hoping to tease out of you guys, that to buy the same type of asset, yes, of course, with more properties in a portfolio, that would be more expensive. But to your exact point, Tom, if you were looking to go buy a $500,000 single family home or a $300,000 portfolio, I mean, you could do that. So the fact that it's a portfolio doesn't intuitively mean that it will be more expensive on a dollar per unit basis or on a just total dollar amount basis.
Yep. Great point, Michael.
Right.
See how I said your name that time? It's just
Thanks.
so much of
Michael.
life.
Going up, inflection.
It's not what
Inflection.
you say, it's how you say it. So
right.
Great point, Emil. Great point, Michael. Barrier to entry, less buyers. And Michael, there's different ways to spend more capital. Anything left here on the benefit side, or should we jump into some kind of tips and tricks along the way?
When it comes to the financing of portfolios, it can often be done a little bit differently. And so it can be really advantageous depending on how you're going to finance it. There's something called portfolio loans. They kind of have a double meaning. People refer to them and use them in slightly different capacities. Some people will refer to a portfolio loan that remains on the books of the lender. It's held in their own portfolio. And so that's technically a portfolio loan. But then there are also portfolio loans that actually spread across a portfolio, a single note across multiple properties inside someone's portfolio. That's also referred to as a portfolio loan. So you just want to understand who's using the term and what and how they're referencing it. But if you go get a portfolio loan, let's say across 5 properties, you get a single note. It encompasses all 5 properties. That's only one loan, and that's not going to be a Fannie Freddie traditional or conventional loan. So that's not going to use up one of your 10. Versus you go finance those properties individually. If they're all single families, you're going to go use five loans of your 10 loan limit. And so from just a ease of financing perspective, portfolios can be great. And then they also can be easier to cash out refi of or get a line of credit against, because they will often be looking at the total equity as opposed to individual properties. And then you can also, Tom, as you mentioned, get savings when it comes to the actual financing costs, because you may only be originating one loan as opposed to 5 separate individual loans.
That makes sense. I'll walk through a little bit of my use case and then tease out some specific tips and stuff that I thought was effective along the way. So I bought a portfolio out in Atlanta. It wasn't a big portfolio. It was 3 homes, but they were all in fairly nice neighborhoods. Within the offering process, I offered on the 3 of them and got a little bit of a discount. And the seller was kind enough to let me set them up into unique transactions. So even though I made the offer negotiation of the 3 of them at once, we were able to close the 3 of them separately because I hadn't filled out my 10 loan limit. So I had individual loans and individual transactions. Normally with a portfolio transaction, it would be just the single transaction to close all 3. But in this particular use case that I had, I broke it up just because I wanted to take advantage of that cheaper financing that I had available. Let's see. And so I acquired them, 3 separate transactions after the negotiating on them as individual, 3 individual transactions after negotiating them as a portfolio transaction, and then just loaded them all up with a property management company that I'd worked with before that I had a lot of trust in, and was just able to kind of quickly scale that group up a little bit more with some more properties. Some tips in doing it, I had alluded to this a little bit before, but really rigorously underwrite each individual property and come up with an appropriate discount. And with these sort of portfolio transaction, there definitely is something to getting a little bit more of a discount. So I had underwrote each of them, kind of came at a price, and then added it all together, and then haircut it off another 5 or 10%. So use that sort of as a starting place from it. And from the seller's point of view, who cares on where the dollar amount is going towards each one? I guess in this case it did matter because we ended up doing individual transactions. But thinking of it all kind of holistically together, the 3 properties that make up the whole of the portfolio.
Tom, I'm curious, in that transaction, for a due diligence perspective, did you just look at one of the properties and kind of say, oh, well, it's the same owner, so they're likely going to be in similar condition, or did you do inspections on all of them? Talk to us about how you did that.
Yeah, so I did inspections on all of them. And the way that portfolio transactions are set up, there's a lot of flexibility. I've seen portfolio transactions where someone would have maybe 20 properties and they're allowed a certain number of kickouts. So depending on the size of the deal you're doing, you can get kind of creative with that. And when I say kickouts, it means, okay, I'm planning to go buy 18 properties. I'm going to make an offer on these 20. And if 2 of them don't look very good, I can say, nope, take that out of the portfolio transaction. So there's really some flexibility in the way that these contracts can be structured of doing these portfolio deals. And it's like oftentimes very much kind of, creativity of the buyer and the seller on how they want to get comfortable to make the deal happen.
That's great.
What are some other kind of fun portfolio stuff? So I'd mentioned Roofstock has some really cool tools for buying portfolios. Go ahead, Emil.
Keep raising my hand. I'm being very polite today.
No, throw some elbows, Emil. NBA season's about to start.
Class is in session.
In trying to remain neutral and unbiased on our podcast, what would you say are the disadvantages of buying a portfolio?
So downsides of a portfolio would be perhaps you don't do the same rigor in underwriting an individual property as you would in a portfolio. I could say that could be mitigated by doing the work, right? By doing the same level of rigor. But perhaps if it's like a bigger portfolio, maybe 20 homes, 50 homes, whatever, it can be hard to apply the same sort of level of diligence. The other one is perhaps if it's in a market that's newer to you, or the property manager is someone you haven't really established that trust with yet. There could be an issue instead of just having one bad apple, that's going to be 2 bad apples that you're managing with that property managers. But again, that can be mitigated by being really thorough in the way that you're evaluating your vendors and in doing that.
Another risk to think about is your aggregate risk from a natural catastrophe standpoint. And this is something we looked a lot at in the insurance world, is if we have too many properties that we're insuring in this one general area and there's a fire or a hurricane or a flood, it's going to damage all of those properties. So same thing, same risk to you as an owner operator. If there's a catastrophe in the area, that could affect all of your properties unilaterally. And so that can be problematic. So you just want to be sure that you have kick butt insurance, sound type policies with great carriers, because what we saw happen in 9/11, to use as an extreme example, is a lot of insurance companies actually went out of business because they had taken on too much risk in the area and they just were paying out all these claims. And so after post 9/11, there were a lot of carriers that just went out of business. And so people think, oh, I have insurance, that's great. But if the insurance company has taken on too much risk in an area, your insurance company could go out of business, which is a pretty scary thing to think about. So highly unlikely to happen. And I don't want people running to their insurance carriers saying, oh my God, I want to make sure you're still going to be in business. But just something to think about as an operator getting heavily involved in a particular or singular geographic area.
Yeah, natural disasters, another one, perhaps there's something, if you're buying in a smaller area and something major happens to the economy, by getting more concentrated in an area, there's a little more risk of a single point of failure. I would say, that doesn't keep me up at night. But under the guise of coming up with more reasons why getting geographically dense with a portfolio would be a bad idea, that could be another reason. Something
else is just systematic and habitual issues. So if the owner never cleaned the filters for any of the HVACs of any of the properties, that might not come up in inspection, but you might start losing all of your furnaces simultaneously across the portfolio. So deferred maintenance, how one property is maintained in a portfolio is likely going to be indicative of how the other properties are maintained. Hence the reason for my prior question, Tom, about the due diligence. I think it is important to evaluate kind of each and every property to verify or nullify that assumption.
100%. And to piggyback off of that point, perhaps the seller, the properties are occupied and the tenants weren't screened properly, or perhaps the previous property manager did a bad job and you're inheriting a hornet's nest of angry tenants. So again, to that sort of single point of failure in doing that. But like I said, I think in going through the proper diligence process, those risks can be mitigated quite a bit. Awesome. All right, guys. Well, I hope you enjoyed the episode. If you could like, subscribe, all of that good stuff, we always appreciate that. And as always, happy investing.
Happy investing.
Happy investing.